We at the Fed understand the hardship that high inflation is causing. We're strongly committed to bringing inflation back down, and we're moving expeditiously to do so.
Inflation has been much more persistent and stubborn than originally anticipated. Last week's inflation numbers showed that for May, headline inflation came in at 8.6% year over year, and core inflation, which strips out the volatile food and energy prices, is up at a slightly lower rate of 6%. The readings also showed that price increases have broadened over a wider number of categories, which is concerning, and the largest contributors to the rise in prices were shelter, energy, and food. And this is really not headline news to anybody who has filled up their gas tank or has gone grocery shopping recently. Energy prices were already increasing even prior to the Russian invasion of Ukraine. And when you take into account the invasion, along with the resulting sanctions against Russia, one of the world's largest energy exporters, it's really complicated the picture for commodity prices. Year over year, energy prices have increased over 33%, with gas prices even increasing more quickly by over 50% year over year. So the latest inflation numbers really did cause a fresh round of heightened volatility and uncertainty in the markets. First off, expectations for the Fed funds rate correctly changed after the inflation reading, with markets pricing in a new 75 basis points hike, which we saw occur at the Fed's June 15th meeting. We also have seen a flattening of the Treasury yield curve, with rates increasing at all durations, but the fastest at the 2 and the 5 years. We've also seen corporate bond yields over Treasuries. Their spreads have been widening, and the spreads between investment grade and non-investment grade bonds have also been increasing. And if you kind of read the tea leaves historically, this has told us that defaults are going to rise and the economy is expected to get worse. And then finally, the stock market itself entered into a bear market. So the Fed did hike the federal funds rate by 75 basis points, bringing the rate to a range of 1.5 to 1.75%. And this is a more aggressive increase than was expected from just last week, before the most recent inflation numbers were released. The Fed did note in their press release that they are being highly attentive to inflation risks, and Powell did, during his press conference, take a decidedly more hawkish tone.
We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses.
Also, I think what's notable is in their most recent set of projections, the FOMC did pencil in a Fed funds rate of 1.9% by the end of the year and 2.8% in 2023. Now they released new projections, and now they're projecting the Fed funds rate to end the year at 3.4% and 3.8% next year. This is a huge upward revision in the pace of the Fed funds increase, and they represent the most aggressive tightening cycle since the 1980s if they're able to do this. They have also revised downward their projections for GDP, and they revised upwards their projections for inflation and the unemployment rate. For the rest of the year, I think we're going to see heightened and continued volatility and uncertainty as markets try to read and interpret the economic data that's going to come through and what the Fed is going to do about it. The Fed really has a very narrow path to bring inflation under control without causing a recession. And markets, consumers, and businesses are going to be sensitive to data showing that potentially the Fed is not getting it right. Again, the Fed is in a really difficult position here, and I try to think of it in terms of the Goldilocks and the Three Bears scenario. Rates can't be too high, otherwise the Fed will cause a recession. Rates can't be too low, otherwise high inflation continues. But rates need to be just right in order to get the soft landing that the Fed is hoping for. Unfortunately, a recent poll of economists believe that the Fed won't be able to pull off this soft landing, and Powell himself in the press conference noted that the path to bring down inflation without a recession is not getting easier over time.
Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store.